Mm-hmm.
they leave out a risk factor associated with debt mathematically. And so we look at a very inaccurate and primitive measure of leverage. And so if I can borrow this money at 2% and I can invest it at 8, why am I not making 6? Well, A, you left out inflation. B, you left out taxes. But aside from that, and that's pretty basic because this is the argument. It's that it is that the argument is that primitive.
Right.
But you did not adjust for the risk you took on. Because I think we can all agree if you have a business that's doing $10 million top line and you've got $12 million in debt, you have a lot more risk than if you had $2 million in debt.
Mm-hmm.
And even $2 million is more risk than if you had zero debt.
Mm-hmm.
We can agree that debt is equal to risk.
Mm-hmm.
And if we can agree to that, then we ought to be able to assign, if we're going to really get down in the analytical jungle, we can assign a mathematical formula to that. Well, ta-da, there is one. It already exists. We just never applied it in that. In the investment world, they teach us to adjust. You don't compare an aggressive growth stock mutual fund that has a high peaks and valleys on the graph, volatile, with a growth and income fund, which has almost no peaks and valleys. So a growth and income fund may have a beta of meaning it is only 80% as risky as the S&P. And you're comparing it to an aggressive growth stock mutual fund that might have a 2.0, meaning it's twice as volatile, risky.